Hello everyone and welcome. Today, we're diving into The Oracle's Playbook, a journey through the timeless wisdom of Warren Buffett. We'll explore his proven strategies for valuation, maintaining discipline, and mastering the art of crisis management. We'll look at critical historical moments like the crash of 1973, the dot-com bubble of 1999, and the meltdown of 2008, and see how Berkshire Hathaway's philosophy, steeped in common sense and long-term vision, navigates these stormy waters. This isn't just about theory, it's a practical guide for securing your financial independence, understanding how to act as a source of stability when others are in panic. Let's start with rule number 1: never lose money. And rule no. 2: never forget rule number 1. Now, this isn't about avoiding the normal ups and downs of the market. We all know volatility is part of investing. What this rule truly emphasizes is avoiding permanent capital loss. The math of recovery is brutally honest. If you lose 10% of your nest egg, you need an 11% gain to get back to even. But if you lose 50%, you need a staggering 100% gain just to break even. And a 90% loss? That requires a 900% gain. It highlights why preserving your principal is paramount for long-term security. It's about protecting what you have so it can grow meaningfully over time, not about dodging every market fluctuation. A key to prudent investing is knowing your circle of competence. This means understanding what you truly know well, and just as importantly, what you don't. As Warren often says, the edge of your circle is far more important than how big the area inside it is. You don't need to be an expert in everything. If you understand familiar, enduring businesses, like consumer goods, furniture, or established banking, that's where you should focus. Avoid fads or new paradigms you don't fully grasp, whether it's dot-coms, biotech, or anything else that seems too hard, or beyond your understanding. Stick to what makes sense. The world changes, but some fundamental values remain constant, ensuring your peace of mind and financial security. When Berkshire Hathaway looks at a deal, it's a very different process than what you might see elsewhere. First, we avoid auctions entirely. Auctions drive up prices, and they're often won by those willing to overpay. We prefer to wait for business owners to approach us, owners who care deeply about the legacy of their company, not just the highest bidder. Second, we apply a manager filter, looking for intelligence, energy, and, critically, integrity. Without integrity, intelligence and energy can be dangerous. Finally, it's about love over money. We acquire businesses from owners who have poured their lives into their work, who want to keep managing because they love the business itself, not just the potential payout. It's the anti-flip. Unlike many private equity firms seeking a quick exit, Berkshire seeks a permanent home for these companies, attracting sellers who want their legacy protected, not stripped for parts. This approach builds enduring value and truly generational wealth. Let's look at a concrete example: the 1973-74 market crash. This period truly proves the wisdom of price is what you pay, value is what you get. In this downturn, the market plunged 56%, and stocks were abandoned, with PE ratios hitting single digits. Wall Street was in a full-blown panic. This is when Warren Buffett invested $10 million in the Washington Post, buying shares at $5.63. He had meticulously calculated the intrinsic value to be around $20, meaning he was buying at roughly a quarter of its true worth. He famously quipped, "I feel like a highly sexed man in a harem." This is the time to invest. The market actually marked it down another 20% after he bought, testing his conviction. But he held firm, and that investment eventually yielded over a 100-fold return. It's a powerful lesson in seeing opportunity where others see only fear, and having the patience to let true value emerge. One of the unique aspects of the Berkshire Hathaway model is its hands-off, trust approach. Unlike a standard corporate conglomerate with a massive, centralized headquarters, hundreds of staff, and top-down directives, Berkshire operates with a remarkably lean structure. Warren and Charlie, along with about 25 people, oversee a vast empire. There's no HR department, no legal department, no strategy meetings dictating to the individual companies. We acquire businesses where the management team is often already financially secure but loves the work they do. We don't interfere with their passion or dampen their entrepreneurial spirit with corporate directives. This is an anti-flip model designed for forever. We empower great managers to continue doing what they do best, fostering an environment where success is driven by those closest to the business, rather than by distant executives. Now, let's talk about the discipline of standing alone, especially during the dot-com bubble in 1999. It was a time of immense pressure. While the Nasdaq soared by 66%, Berkshire Hathaway's stock was down 20%. Warren Buffett was widely mocked, even featured on the cover of Time magazine asking, "What's wrong, Warren?" for missing the new economy. But he steadfastly refused to buy into businesses he didn't understand, sticking to his principles of value. This situation reminds me of the parable of the oil prospector in Heaven Street. Peter tells him the oilman's pen is full, so the prospector shouts, "Oil discovered in hell." All the other prospectors stampede out, making room. Then, the prospector himself, after a pause, follows, saying, "There might be some truth to the rumor." That's the danger of social proof. The outcome? The bubble burst in 2000. While others faced insolvency, Berkshire had the cash to acquire 8 companies for $8 billion. His sound judgment paid off, proving that staying true to your investment philosophy, even when unpopular, leads to lasting financial stability. Let's examine crisis management example 1, the LTCM rescue in 1998, comparing the committee approach versus the sovereign. Long-term capital management, a large hedge fund, was collapsing, threatening the financial system. The private consortium, organized by the Fed, involved 14 banks. Their process was slow, burdened by deliberation and meetings. They injected $3.6 billion, kept management, and offered a soft rescue. It solved the crisis but suffered from free rider problems, with some banks, like Bear Stearns, refusing to join. Contrast this with the Buffett bid. One person, Warren Buffett. The process, a single fax, with a 1-hour deadline. His terms, $250 million for the portfolio, immediate firing of management, no bonuses. His bid expired because the consortium acted first. The key insight here is clear: Buffett is a liquidity provider, but only on his own, ruthless terms. He doesn't act by committee, and he demands a premium for instant capital and certainty. This showcases the power of decisive action when market stability is at stake. Moving to crisis management example 2, the Bear Stearns run in 2008. This illustrates that when liquidity evaporates, it happens instantly. Bear Stearns relied heavily on overnight funding. When confidence vanished, that funding dried up in days. We saw $17 billion drain away, leaving them with just $2 billion. They desperately needed a savior. Lazard approached Buffett to bail out Bear, but he declined. Why? Because he doesn't rely on the kindness of strangers, and critically, he saw no margin of safety in their murky derivatives book. He refuses to catch a falling knife unless the price fully captures the immense risk. The outcome is well-known. Bear Stearns was sold to J.P. Morgan for a paltry $2 a share, later adjusted to $10, and only with a massive $29 billion federal backstop. This highlights the importance of financial prudence and avoiding unnecessary risks in complex, opaque investments. Our third crisis management example is the Lehman moment. This was the point where "too big to fail" was no longer an absolute guarantee. CEO Richard Fuld called Buffett for capital, hoping his involvement would signal confidence and stabilize the firm. However, Buffett's analysis involved reading Lehman's 10-K filing. What he found was accounting he deemed confusing and asset values that were suspect. There was a fundamental disconnect. Fuld misinterpreted Buffett's terms, and there was no meeting of the minds on valuation or risk. The private consortium tried and failed to rescue Lehman. Barclays was blocked by UK regulators, and the U.S. government, after the Bear Stearns experience, refused a backstop. As Buffett understands, when liquidity vanishes, if you rely on consortia, you die. Berkshire relies only on its own cash, underscoring the critical importance of self-reliance and deep due diligence in understanding the true state of a company's finances, especially in a crisis. Now, let's look at the offensive side. Buy American. I am. This was Warren Buffett's famous New York Times op-ed in October 2008, where he switched from saying no to saying yes during the height of the financial crisis. His message, be fearful when others are greedy, and be greedy when others are fearful. While others panicked, he saw opportunity. He made 2 significant investments. First, $5 billion into Goldman Sachs, taking perpetual preferred stock with a 10% dividend, plus warrants. His logic was that Goldman faced a liquidity crisis, not a solvency crisis. They were illiquid, but the underlying assets were sound. Second, he invested $3 billion in General Electric, again with preferred stock yielding 10% plus warrants. His reasoning for GE was skating to where the puck is going to be, anticipating their long-term recovery. The crucial distinction was that Lehman was insolvent, while Goldman, though illiquid, still had quality assets. Buffett provided much-needed credibility and capital, but he charged a premium price for that certainty and confidence, demonstrating how to capitalize on fear with strategic, long-term investments. Let's compare the 3 main models of liquidity provision during a crisis. First, the private consortium model, like the LTCM rescue. Pros: the industry attempts to solve its own problems. Cons: it's slow, requires consensus from many parties, and proved fragile, collapsing in the Lehman crisis. Speed: low. Second, the government model, like Dodd-Frank or TARP. Pros: an unlimited balance sheet can stabilize the entire system. Cons: it carries moral hazard, involves bureaucratic delays, and often leads to political fallout. Speed: medium or variable. Then, there's the Berkshire model, exemplified by the Goldman Sachs investment. Pros: instant decision-making, immediate cash injection, and a single, decisive decision-maker. Cons: it's expensive for the borrower, as the cost of capital is high. Speed: high, almost instant. The clear takeaway for investors is that in a true crisis, the most valuable asset isn't a committee or even a government. It's a single decision-maker with readily available cash and the willingness to deploy it. That agility and certainty are what truly make a difference. Now, let's uncover Berkshire Hathaway's secret weapon: insurance float. This is where a significant portion of their money comes from. Insurance companies collect premiums up front, effectively creating a pool of cash in. This cash is called the float. It's a stable, long-term capital pool because it cannot be withdrawn in a run, unlike bank deposits. Berkshire then strategically invests this float into stocks or acquisitions, essentially deploying that gunpowder for growth. Claims are paid later, as they arise. While banks in 2008 were forced to sell assets to raise cash during the crisis, Berkshire used its structural advantage, this consistent, reliable float, to buy assets at bargain prices. This structural advantage is the engine of Berkshire's financial fortress, providing steady capital for strategic investments and long-term growth, giving them a significant edge in any market environment. Let's summarize with the investor's checklist, offering tried and true principles for your financial future. First, preserve capital. Always understand the math of recovery. Losing 50% means you need a 100% gain just to get back to where you started. Second, stay within your circle of competence. If you don't truly understand an investment, don't make it. As they say, if you don't know who the fool in the game is, it's you. Avoid new paradigms that promise the moon. Third, demand a margin of safety. Remember, price is what you pay, value is what you get. Always aim to buy at a discount to intrinsic value. Fourth, cash is independence. Never rely on short-term funding or the kindness of strangers. Maintaining a strong cash position gives you options and security. And finally, panic is opportunity. When the super cat strikes, and others are running for cover, be the only one with the checkbook open, ready to invest. These are smart decisions for a secure and prosperous future. Ultimately, the temperament of wealth is perhaps the most crucial element. As Warren Buffett famously put it, the stock market is a device for transferring money from the impatient to the patient. The strategies we've discussed today, valuation, discipline, and liquidity management, are simple to understand in theory, but incredibly difficult to execute consistently. They demand the ability to stand apart from the crowd, whether that crowd is caught in euphoria or paralyzed by terror. True success in investing comes down to emotional discipline. It's the most reliable edge you can cultivate for enduring prosperity. Patience and a steady hand are what truly unlock long-term financial security and allow your wealth to grow significantly over time. Thank you.